9:49 p.m. February 9th, 2012. This is interesting. I'm looking at a chart, and I won't tell you what it is, but if you know me, you know what it is. It's just a meandering line graph. It could be a candle graph, but because I've got values on it, I've given away what it is, so you know it's not price. But if it was a candlestick graph, you'd had some idea. It's RSI, and I've enlarged it. There's only one place on this graph where we have a series of lower lows below 30% that vary by more than 5%. Now let's look at the graph. There's lower lows right here, but they only vary by 1%. It's insignificant. And there's lower lows here. Look, we have a low here, but a higher low here. It goes from 22.8 to 30.4. So it's a plus 7.6 divergence. And it's my theory that when the RSI divergence is more than 5%, and I haven't read this on the net, I just made this up through just being observant, it has significance. And let's look and see where that signal is. Where do you think that signal was? That is the question. So now I can minimize RSI and just show you price. But imagine if RSI could be drawn not as a line graph, but maybe as candles. I don't know how you do that, but I find that an interesting principle. So here's gold today, 5-minute chart. We sell off from 1450 per forward, but that's, sorry, I'm a bit dyslexic. I said 1450, but it's 1750. I meant to say this. So this price right here is 1745, and we grind down. So the signal that I showed you was right here. That's that little reversal right there, I believe. And it did go on side, but look, right here, that's the low at, I think it's 740, that red candle. They vary by one tick between that red and green candle, but that's where the RSI divergence is. And this line right here, which is not very bold, is the fourth test of the Orney daily trend line. And look, we hold it and we go on side from, the price there is, I'm trying not to say any nonsense words like ahs, or 1725 to 1730. So we're up 5 points. So if I show you RSI with price, so you can see that the only signal that's more than 5% that crosses the 30% boundary for oversold just so happens to be at the day low and on the fourth test of a strong daily trend line. Do you think that's a coincidence? Surely not. There's no way that's a coincidence. And bearing in mind, I'm sorry, that was the 1-minute chart. In the 5-minute chart, if I go back to that and show you the same price behavior, there is no bullish divergence in the 5-minute chart, because it's my idea that when there's a signal in the 1-minute chart, but not the 5-minute chart, it's a low momentum price reversal. If there's a signal in both, it's high momentum. So when you're on a key level and you don't see a bullish signal in RSI where you would expect it, if you drop down to the lower time frame, regardless of what time frame you're on, if you see a signal, then you have an entry. If you're in the daily chart, you go to the hour chart, then you go to the 5-minute chart, and you have 3 signals, and I call that fractal divergence, because by doing that, it helps to narrow down where the price reversal might occur, because across this time invariance, we're seeing a change in momentum. And it's logical that on all time frames, be it 3, we're seeing a change in momentum as we approach a level where we have the expectation of support or resistance. That's just my idea on the momentum of price reversals. And before I conclude, I'll show you the daily chart and that trend line because it's relevant. So we'll go to the 6-hour chart and we'll do 30 days. And you can see, well, you might not see very well. First test back here on December 29th. We're looking at this line here for the untrained eye. Second test. Third test where there actually was a bullish divergence of 6%. That was just below the previous low there. And that's my cluster strategy, which James took. But I missed the support level from the day before, and I'm really picking. I didn't take it on. It's up $30 that day. But here, you can see we're back on the same trend line. Markets are not random. The structure amongst the chaos. The stochastic nature of markets, all the variance between the input and the output for all the emergent behavior of all the market agents. Of course, there's iterations on these equations, but there's also iterations on our opinions on where the value lies, and value and perception of value is always changing, and we all have different agreements, but clearly everyone agreed that was a good place to buy gold today. Beautiful.